We often get asked about seller financing, and what seller financing is that the seller becomes the bank and the payments are made to that seller rather than a new loan coming to the property. One of the problems that usually happens is usually the seller has an existing loan on the property, or there's more work that needs to be done to the property, so there needs to be construction funds and everything else. If you're getting a new hard money loan, the hard money lender is going to want to be in first position on the property, meaning the first loan. And in most cases, they're going to want to be the only loan on the property. So what seller financing is the seller is actually financing part of that. So rather than doing a seller financing deal with a hard money lender and getting the seller to finance a portion of it, what we do is a seller partnership. This is basically how it works. Okay, let's say you've got this house that you're going to purchase. Let's say, we're just going to keep easy numbers here, guys. Let's say the ARV is $100,000. Let's say you're able to get 75% of that, so it's a $75,000 loan. Let's say your closing costs are $10,000, and let's say your interest is $5,000. These would be closing costs, points, all that type of stuff. I'm just using numbers for the principal. Let's see, $5,000 is going to be your interest. And let's say the rehab on this property is $20,000. Okay. And this is going to be the rehab. So if we take all that off, what are we, 20, 35? So that's $40,000. Okay. $40,000. That would be the purchase. But let's say that the seller, instead of needing $40,000, really needs $50,000, okay? And, or $45,000, let's make it even easier. Let's say in this example that the seller needs $45,000, but you don't have the extra $5,000 to bring to pay the seller so that you can get that. And the lender is not able to do any more on that ARV. That's just the best value. The rehab, maybe the rehab came in more than you thought it was going to, or something changed in the process. Maybe the value came in less than you thought. The rehab came in more than you thought. Maybe some costs were more than were anticipated. This happens frequently, which is why you need backup plans. So in this situation, if you don't have the money to pay the seller that extra $5,000, first thing you're going to do is try and renegotiate with the seller. Hey, can you go lower? Can you do this? Let's say you renegotiate with the seller and the seller says, hey, I'll go down to $44,000 instead of $45,000. So now we're $4,000. Well, guess what? You still don't have the $4,000. So this is what you can do. You can say, okay, seller, this is what we're going to do. I'm going to get a new loan on the property for $75,000. That new loan is going to pay all the costs and the interest. It's going to put all the money in the rehab. We're working with this awesome company that's doing all this for us. And what we're going to do is we're going to sign a promissory note, just like a credit card or anything else like that. I promise to pay you for $4,000, okay? I promise to pay you $4,000. And I'm gonna pay you that $4,000 when I sell the property. And I'm gonna sell the property for $150,000, okay? So what I'm gonna do is after the lender gets paid, you're gonna be the next one to get paid, and you're gonna get $4,000 plus I may pay them some interest. I might give them some profit. I can negotiate, or I may just say, I'll give you the $4,000 and, well, I want something more out of that. Okay, well, what would you like? And then we negotiate. Well, maybe an interest rate. What interest rate would sound good? We negotiate with them to come up to that, or maybe it's like, hey, I won't give you that, but I'll give you part of the profit margin that I make after all costs. Those are all things you can do to sweeten the deal to get someone to go with you versus someone else when you're trying to put these deals together. So this is a seller partnership. Now, they will sign a loan, but that loan will not be attached to the property. It will be only a first loan against the property to the hard money lender. This will be what's called a non-securitized loan. It's a loan and you owe the money to that individual, and it's signed, and they can take you to court or do whatever they want to do on that. But what they can't do is attach it to the property. So that's what makes the hard money lender comfortable with the situation. And then you're able to do a independent note with the seller, and the seller can get some more upside, or you can make a deal happen, or the seller can just get the property sold. So there's some great advantages to everyone in a situation like this.